मॉर्निंग एवरीवन। जी जरा शेयरिंग का राइट्स दे सकते हैं? यस। ओके। ओके। ऑल राइट। गुड मॉर्निंग एवरीवन। गुड मॉर्निंग प्रशांत, गुड मॉर्निंग सम्यनाथन, गुड मॉर्निंग आकाश, गुड मॉर्निंग। So today's session will be a revisionary class on Ind AS 19 that deals with employee benefits. Okay, so have you gone through the standard before or the sessions before? Anyone? Yes, you can feel free to interact. There is no problem. Yeah. Anybody has gone through the sessions? Anybody has seen, known the standard, studied it before? Because this is going to be more of a revisionary lecture. So you can just help me out. Yeah. So that I know from where do I start. Okay. Yes.
I am attending for the first time, sir.
Asha, you are attending for the first time. This was
Sorry, sir.
your name? Prashant. Okay. Yeah.
Prashant.
Right. Okay. All right. So we quickly run through what is the, I mean, since this is a revisionary class with just one day to cover up the standard, it's something which was already there in your intermediate. So there is nothing that is new per se. And also this is something that is entirely easy to correlate with what we do. Okay. So when we talk about Ind AS 19, basically we look at employee benefits. So all your employee benefits would be categorized into four broad categories. Okay. So what are the four broad categories? One is short-term employee benefits which end up being paid within a period of 12 months. Post-employment benefits, which is typically after the payment of, after the employment tenure gets over. Other long-term employee benefits, this is a residual category, and termination benefits. So when we say short-term employee benefits, payable within 12 months, this typically includes salaries, wages, leave encashment, short-term rewards, whatever gets paid. So that comes under your short-term employee benefits. Post-employment benefits, these are the benefits that will be paid to the employee after the employment is over. It is quite different from termination benefits. Termination benefits is the benefits that are paid when an employee is terminated. He is asked to leave. That is your termination benefits. Like a retrenchment compensation, for example. A 3-month salary when an employee is asked to leave, that is known as your termination benefits. Post-employment benefits, these are the benefits when an employee resigns or retires on superannuation. So that becomes your post-employment benefits. What comes here is typically your gratuity, accumulated leave also comes here. Okay. All of them will come and sit under post-employment benefits. Other long-term employee benefits, this is like a residual category. So this is obviously not a short-term benefit. So it is payable beyond a period of 12 months. It is not a post-employment benefit. So it is something which is paid while the employee is still in service. It is not a termination benefit. So it is not something like a retrenchment compensation. So what could it be? A long-term service reward. Suppose an employee has completed 10 years in an organization. the management wants to reward him for the for the dedication that he has given to the company for a decade of his lifetime of service. So that will become other long-term employee benefits because the employee is still in service, so it cannot be post-employment. When he joined, it was not immediate, so therefore it came up towards the end. He has not left or he has not been asked to leave, so it cannot be a termination benefit. So that becomes other long-term employee benefits. Now the question is, what is the purpose of this standard? This standard tells you how to account for these expenses. This standard tells how to account for these expenses, how to present the liabilities in the balance sheet. So these are the two broad objectives of this standard. So how to account means we know we have to account it on accrual basis. You will be very comfortable with short-term employee benefits, no doubt. Why? Because this is something we do on a regular basis. Salary, employee has rendered service, so automatically their current cost, we make an accrual of the expense, credit the payable, and on payment, the payable gets debited and money is gone from the bank. So that takes care of your accounting. But tell me one thing, is this all that is visible for an employee's benefit? Suppose an employee joins today and gratuity under the Payment of Gratuity Act has to be paid after a period of 5 years. Suppose he leaves exactly at the end of the 5th year. Do you think gratuity will be payable to him? Yes, it will be payable to him. My question is, if the gratuity is payable to him, when has the liability for gratuity accrued? Look at my question carefully. When has the liability for gratuity accrued?
Over the 5 years.
Over the 5-year period. That's right. It's not something that suddenly pops up on completion of 5 years. It is something that is proportionately getting accrued for every day of service that he is putting, which in turn is turning out to be a 5 year of continuous service. So at that point of time, don't you think that we need to accrue for the gratuity liability on a step-by-step basis each year? Yes, what do you think? Don't you think we should
Yes, sir.
accrue step-by-step basis? Yes.
Yes, sir.
So now my question is, how do I know at the start that I should accrue this? Because 5 years is a very long time. If I look at a 5-year tenure, how do I know whether the employee will be there after 5 years? Yes, I really don't know. He may resign. He may, God forbid, something could happen to him. Yes, there's so many things that are there, so many assumptions that are there. All these complexities are addressed by this particular standard. How to do the accounting. So the easier part is short-term employee benefits, which is basically your salary, wages, whatever gets payable within 12 months, that gets accounted here. But what is not so easy is accounting for a gratuity accrual, accounting for long-term service rewards. Termination benefits also is quite easy. Okay, it's quite easy compared to post-employment or other long-term employee benefits. Is it okay? Yes. So that is how this standard, that is the objective of this standard. Basically, an employee's gratuity is a deferred payment. Today, the employee is putting in his service for a payment that is expected to be given to him at the end of the 5-year period. Yes. So therefore, at the end of a 5-year period, if something is accrued to him, if something is payable to him, that is because of the service he has rendered in these 5 years. So by virtue of rendering the service over a 5-year period, the organization is getting some benefits out of it. An employee works, because of that work, the organization gets benefited. So against the benefits by the organization, you need to match the cost. So if I look, ultimately, it is a cost matching that is being applied, a matching principle that is being followed. Are we okay? So that is the whole objective of this standard. Okay. So there are a couple of exclusions. You have employee share-based payments, ESOPs popularly called. They are covered under Ind AS 102. Accounting and reporting by employee benefit plans. We will see this later towards the session. What do you mean by employee benefit plans? But this is what we are excluding. Okay. So these are the two things which are excluded from the scope of Ind AS 19. One of it is obviously because you have a separate standard that is there for that. Is it okay? So far, is it fine? Yes. Good morning, Priyanka. Good morning, Anushi.
Yes, sir.
Okay. Good morning, Resham. Good morning.
Yes,
Okay.
sir.
All right, fine. So coming to the next one, I have to be fast because I have only one session. So don't feel offended. Okay. So when I come to short-term employee benefits, due to be settled within 12 months, what all comes here? Salaries, wages, social security contribution. Social security contribution, something like your provident fund payments, right? That is a social security contribution. We will see more on PF and such security contributions later, but that comes under a short-term employee benefits. Paid annual leave plus paid sick leave. Okay, so an employee is entitled to something known as a privilege leave or an earned leave for every 6 or 7 days or 10 days or 15 days of continuous working. 1 day's leave gets added. So that becomes annual leave. Profit sharing and bonuses. So this is also going to be short-term employee benefits and certain non-monetary benefits. Okay. So what happens here is straightforward accounting. There is no need for actuarial assumptions. What are actuarial assumptions? We will have a look. Because there are no actuarial assumptions, there is no gain or loss, no actuarial gain or loss. Measured on undiscounted basis, because it is payable within 12 months, there is no need to do a discounting of this. No specific disclosures under Ind AS 19. Other standard disclosures can apply. For example, if you are making a payment of salary to the managing director of the company, then this will become a related party transaction. You have to disclose it under Ind AS 24. Entities' expectations of the timing of settlement change temporarily. Reclassification not needed. So suppose you believe that it is a long-term, short-term to long-term for a small tenure, and then it will come back to short-term, then there is no need to reclassify. If it is not temporary, then consider whether it is still a short-term. Otherwise, you may have to move to accounting for long-term employee benefits. So journal entry also very simple. Expenses account debit to liability or to cash. So this is largely what you are having in your what you say. This is what you are largely having in your short-term employee benefits. Okay. Now you will be very comfortable with this. So I will not deal with that in detail. It's something you people are already doing it on a regular basis. What we will look at is paid leave. Paid leave, which is in a sophisticated manner known as short-term compensated absences. We call it as short-term compensated absences. So when I say short-term compensated absences, they are of two types. One is accumulating and the other is non-accumulating. So we look at the easier part first. Non-accumulating paid absences, the leave lapses. The leave lapses, you cannot carry it forward. For example, employees get casual leave. So sometimes some employee organization, for example, gives 8 casual leaves in a year. So 8 casual leaves means what? You don't have to explain anything. You don't have to tell anybody anything. You just take that leave. You just take that leave. This leave will lapse if current period entitlement is not used in full. Okay. It cannot be carried forward. You cannot carry forward this. It will lapse. Obligation arises when absences occur because the employee service does not increase the amount of benefit. You don't have to do anything. This will, the moment you take an absence, the recognition happens. So basically here you don't have to do anything. It is a leave that an employee has taken he gets paid for it, it cannot be carried forward. So this is something that lapses. So you don't really have to do anything. You basically do the accounting of your regular short-term employee benefits, and that leave gets covered in that. That leave gets covered in that. For example, out of an employee working for 300 days in a year, he has 10 days of casual leave. He has 10 days of casual leave. That means total working days is 300. Out of 300, 10 days are casual leaves, 290 days. If he comes, then also he will be entitled to a salary for 300 days. Are you able to follow? Yes? Are you able to follow? Yes?
Yes, sir.
So, what does it mean? Obligation arises when absences occur. Obligation arises when absences occur. What do you mean by this statement? Suppose in the month of, what month are we in? In the month of June, employee comes for 28 days. He does not come for 2 days. You will pay him a salary of how many days? 30 days. How many days has he worked? Sir, he has worked for 28 days. But you are still recognizing an expense for 2 days. You are still recognizing an expense for 2 days. Let us suppose his daily salary is 1000 rupees. I'm keeping it simple so that you can connect. So, for the month of June, he should be actually paid 28,000 because he has come to the office for 28 days. But will he be paid 28,000? No. The answer is he will be paid 30,000. Why? Because he has this entitlement benefit that is available to him. He is entitled to 2 days of casual leave. I am assuming he has not utilized the entire 10 days. So therefore, I am recognizing this 2000 rupees as an expense. When am I recognizing? When he avails the leave. He has availed the leave in June. I am recognizing the expense in June. So 28,000 for the work he has done. 2,000 for the leaves that he has taken. So 28 plus 2, 30,000 rupees is the expense that I am going to book. So recognition is based on the absences occurred. Any doubt so far? Priyanka, Anushi, Prashant, Samyanathan?
No, sir.
No problem. Okay. Yes. All right. Fine.
Clear है sir.
Clear it. ठीक है. So that makes it pretty clear. This is straightforward. Okay. Acha. If he crosses, he has availed 10 days of leave and then he avails another 2 days. So he has taken 10 plus 2. So for this extra 2 days, do you think company will pay him? Answer is no. Why will the company pay him? Company will say you are availing more than what is given to you. So I will consider only those days which you have worked and not this excess. So suppose out of 30 days, he comes for 28 days after exhausting, then it will end up becoming, that's right, a loss of pay. That will end up becoming a loss of pay. Okay. So 2 days pay will be deducted. So straightforward, non-accumulating. Recognize when the absences occur because employee service does not increase the amount of benefit. So that takes care of this part. Now we come to the slightly complicated issue of accumulating paid absences. Accumulating paid absences means what? These can be carried forward. The leaves can be carried forward. Casual leave, they expire in the financial year if you do not use them. But accumulating paid absences, these are the leaves which you can carry forward, which you can carry it forward. Today, suppose I do not avail the leave, it will allow me to take that many leaves in the coming financial year, in the subsequent financial year. So therefore, an employee is working today extra, that is allowing him to take more leaves in the future. So for example, let me make it, let me explain with an example. Suppose an entity gives 10 days of leave. Which leave? This is your earned leave or encashable leave or privileged leave. So what happens is when this earned leave is given, it comes with the caveat, if you do not utilize this earned leave in the current financial year, you can carry it forward to the subsequent financial year, or you can encash it. So either of the two can be done. So now the question is, when I talk about accumulating paid absences, there are two options I told you. Either you can encash, in which case it is known as vesting compensated absences, vesting accumulated compensated expenses. You are entitled to a cash payment for unused entitlement on leaving the entity. So you get money against those leaves which are unutilized. Non-vesting, you are not entitled to a cash payment. You will not get cash. You will instead be entitled to utilize those leaves in the future. So for example, these 10 days are non-vesting. That means what? Suppose current period, he has worked for 300 days. He had an option to avail 10 days of earned leave and work only for 90 days. But has he done that? Answer is no, he has not done that. And because he has not done that, what will happen is, in the next year, there are 300 working days. This is say FY 24-25. In 25-26, he can avail 10 days of the entitlement that is available in the next year, plus the 10 days of carry forward from 24-25, the brought forward unutilized leave also can be availed. So next year, he can work for only 280 days and still he can get a salary of 300 days. Are we able to follow? Yes?
Yes, sir. Because 20 days earlier, unutilized leave.
Unutilized leave. Yes. Prashant, are you able to follow?
Yes, sir, perfectly.
Okay. Priyanka, Anushi, Resham. Yes.
Sir.
All clear?
Sir.
So now
Yes.
understand this. This is something which is slightly technical. By working for 300 days in 24-25, the employee is effectively getting entitled to additional leaves in the future of 10 days. Correct? By working for 300 days today, he is effectively getting entitlement to extra leaves in the future. So now, what is happening? There is an obligation that is arising. Why? Tomorrow, that means in 25-26, an employee typically will come to the office only for 280 days, but you have an obligation to pay him for 300 days. Out of that 20 days gap, 10 days is arising because of the additional work that he has put in 24-25. 10 days you have to pay him because he has not taken a leave in 24-25. He has chosen to serve the organization without taking the earned leave. And therefore, by working today, their entitlement has increased in the future. And that is why we end up creating a liability for this. Even though there is no cash payment, we end up creating a liability. Why? Because in the future, he can work less because today he has worked more. So in effect, the 10 extra days that he has put today is essentially an obligation against the 10 days leave that he can take in the future. समझ में आ गया सबको? Yes, did everyone follow?
Yes, sir.
So that is your non-vesting. Vesting is very simple. You have leave balances. It gets converted into cash. Okay. So that is all about your short-term compensated absences. I would suggest you to go through these questions for homework. It is on similar lines of what we have discussed. It is on similar lines of what we have discussed. Okay. Now, I will just come back to this example and then, we can move to the next employee benefit. See, you people tell me, suppose he is entitled to 300 working. He has to work for 300 days, out of which 10 days of earned leave is available. He has not utilized 10 days. So what will happen is the what will happen is 10 days leave will come up in the future. 10 days leave will come up in the future. My question is, a liability should be recognized for how many days? Should it be recognized for 10 days or should it be recognized for something lower than 10 days? What are you thinking? What is your opinion? Yeah. What do you think? Should I create a liability for entire 10 days salary? Or can I make a liability for less than 10 days salary? Are we able to follow, guys?
Yes, yes. Question is clear, sir.
Question is clear? Yes. Anushi, Priyanka, Prashant, Samyanathan, yes. What do you think?
Yes, sir.
अरे यस सर, तो जवाब दो. लायबिलिटी कितने दिन का रखना चाहिए? ठीक. Let me rephrase the question if it is, if we cannot understand clearly. An employee came for 300 days. He has taken no leave at all. So, effectively, in the next year, he can take 10 plus 10 days leave. My only question to you is, कितने दिन का liability book करना है? What is the liability I need to recognize on 31st March 25 towards the unutilized leave? Should it be for the 10 days extra that he has worked, assuming that he will utilize entire 10 days? Will it be something less than 10 days? Or will it be something more than 10 days? Or will it be, sir, no liability? I'm giving you 4 options. First option, less than 10 days. Second option, liability for 10 days. Third option, more than 10 days. And fourth option, no liability required. Tell me, A, B, C, and D. Which option? You have your MCQs, right? 30 marks or so. Yes? So tell me, liability should be created for how many days? Tell me.
Only these 4 options, sir?
अब इससे ज्यादा और क्या होगा यार? Less than 10, more than 10, equal to 10, or no liability. What else will you have? I think we have covered everything. Yes? Priyanka?
No liability, sir.
No liability. Okay. So I got one answer here. What about Prashant?
I think so, less than 10 days.
Less than 10 days. Okay. What about Anushi, Resham, Nathan? Yes. Okay, fine. Let me do one thing. Let me just write it down. Maybe that will help you think better. Okay. Lines. Yeah. Okay. I got two answers. So number of working days 300. Less earned leave 10. So net working days 290. By coming for 290 days, an employee can get 300 days salary because this is your earned leave. This is your earned leave. आप हक से ले सकते हो. You can take it as your right. What the employee has done, he has come for full 300. Suppose utilized leave is equal to 0. So in the future, he is entitled to 10 days leave of 24 of 25-26. अरे उस साल काम करेगा तो उस साल का एंटाइटलमेंट भी मिलेगा उसको. प्लस he is entitled to 10 days additional leave on account of brought forward unutilized leaves of 24-25. So next year, by working for 280 days, he can effectively get a salary for 300 days. Are we able to understand this? This is something I have repeated multiple times.
Yes.
Now, Priyanka, अभी सोचो. Employee ने, just think rationally. Employee has come today, worked for 300 days, got a payment for 300 days. Next year, employee is giving a work of 280 days. He is getting paid a salary of 300 days. Employee, company. Employee gives a service here for 300 days. Company is getting the benefit for 300 days. So therefore, company pays equivalent to 300 days. Is it okay? Now here, in the next year, what happens is, suppose he avails 20 days. Can he avail 20 days? प्रियंका सबसे पहले ये बोलो, क्या वो 20 दिन ले सकता है? अनुषी, प्रियंका, yes?
Yes, sir.
Can he take 20 days leave in the next year?
Yes, sir.
Yes. He can take 20 days leave in the next year. So let us assume he comes and works for 280 days. But a company, as per the contract, will pay him for 300 days. Do you agree?
Yes, sir.
Yes. प्रियंका समझ में आ रहा है?
हाँ
Agree?
सर.
Yes. अभी जरा use a little bit of your head in the morning and tell me, do you see some disparity here? Do you see some disparity here? In the first case, The company is getting a benefit of his work of 300 days and it is paying a cost of 300 days. In the second year, company is getting a benefit of only 280 days, but company is made to pay a cost of 300 days. Are you able to follow? Yes. यहाँ
Yes,
पे
sir.
280 दिन काम कर रहा है वो. He's working for 280 days. So company is getting a benefit of his services for only 280 days. In spite of that, company is made to pay a liability of 300 days. That means what is happening is here the P&L cost is of 300 days. Here the P&L cost is of 300 days. I am not talking about any approval. But यहाँ पे जो P&L hit करेगा, it is his salary cost of 300 days. But if I look at the benefit, suppose this guy is a sales and marketing guy. By working for 300 days, he is generating a revenue for 300 days. So P&L benefit 300 days. Here the P&L benefit is only of 280 days. Are you able to follow? So in the second year, is there a matching that is happening? Is there a match that is happening? Answer is no. Because I am getting a benefit of only 280 days, but in effect, I am having a cost of 300 days. So there is a mismatch. There is a mismatch. So what the standard says is, look, this guy has not taken any leave. So first of all, understand your payment scheme. Even if an employee works for 290 days, you have to give him a payment of 300 days because that 10 days becomes his unutilized leave which he can carry. Because the 10 days is his leave that is available to him as per the terms of the contract. So even वो 290 दिन काम करेगा, you have to pay him a salary of 300 days. Now in this case, he has worked for 290 plus 10. This 10 is a carry forward. This 10 is a carry forward. And therefore, I have to create a liability for this 10 days. I have to create a liability for this 10 days. In the future, when I create a liability for this 10 days and when I pay him for his 300 days salary, मैं 300 days के लिए नहीं दे रहा हूं. Out of 300, 10 days is a liability of 24-20. 10 days is a liability of 24-25, which I am effectively discharging. And the additional 10 days leave that he has availed, that is the entitlement of 25-26 only. So therefore, correctly, you will end up paying a salary of 300 days, which is basically 10 days settlement of leave liability and 10 days of 25-26 entitlement. I'll just run you through the question quickly so that you are able to understand exactly what I'm trying to explain. Okay? Yeah. Just give me a minute. Which question it is? 8.1. Okay. Vested. Okay. Just look at this question. Okay. This is there in your study mat also. Mr. Niranjan working for Infotech Limited. Consider the following particulars. Annual salary 30 lakhs. Number of working days 300. Leave taken in the first year is 10 days. In the second year, leave allowed 10 days each. In the first year, leave taken is 7. Unutilized leave carry forward is 3. Next year taken 13. Carry forward is 0. Okay. So now let us ignore this for now. Okay. Just don't look at this. Now see. Annual salary 30 lakhs. Number of working days 300. Leaves allowed 10. Leaves taken 7. Therefore, number of days that the employee has worked is 293 days. Number of days that he has worked is 293. 300 minus 7. What the company has said is it will book a salary of 30 lakhs. Next year, 30 lakhs. But he has worked only for 287 days. 10 दिन का entitlement and 3 days to carry forward था, that also is utilized. So company says over a 2-year period, 3 days यहाँ से वहाँ move हो रहा है. That's it. There is no other issue. So therefore we will recognize 30 lakhs in each year. Is this fair enough? Answer is no. Why? Because here see the number of days are more, salary is 30 lakhs. Number of days are less, salary is again 30 lakhs. There is a mismatch. There is a mismatch. So what the calculation should be like is, yaar uska salary cost is 30 lakhs for 300 days. So per day cost is 10,000. Out of 10,000, he has worked for 3 extra days in the current financial year. So that 3 extra days, you will recognize a liability. So first year, the salary cost is 30 lakh 30,000. 30 lakhs, the full period, what he is entitled to. And another 30,000 for the 3 extra leaves that he has not utilized, which will be utilized in the future. So a leave not taken now is giving rise to increased entitlement in the future. So 30,000 rupees is going to come up as your liability for the future. In the subsequent year, 30 lakh to usko milega. That is the payout. But what is the cost? The cost is 25, 26, 30 lakhs entirely. But 3 days is essentially the entitlement of the previous financial year. So that will be reduced. He has availed excess leave in X1, X2. So what should hit the P&L is only 29 lakh 70,000. It should not be 30 lakhs. Because उसने 3 दिन कम काम किया है. But now the people will say, sir, 29 lakh 70 you will book in the P&L, but you are going to pay 30 lakhs. How is that mismatch justified? That 30,000 difference is nothing but this liability which I have created, which I will be reversing. So first year, the entry will be employee benefit expense account debit, 30 lakhs 30,000. This 30,000 is essentially nothing but liability for additional 3 days worked. In the next financial year, employee benefit expense 29 lakh 70. This is for the 13 days leave that he has taken. But the payment that will go is 30 lakhs because it is a brought forward leave which is very much within the entitlement to utilize. So therefore, this provision for leave encashment gets reversed and it becomes 0 at the end of the second year. Are we clear with this? Yes?
Yes, sir. Clear, sir.
Clear? Priyanka, समझ में आ गया?
हाँ गया सर.
Yes. Anushi, did you follow? Prashant?
Yes, sir. Perfectly.
All clear? Okay, fine. Now, what the standard tells is the liability that you are going to create. In this case, 3 days was the unutilized leave. Should I create a liability for entire 3 days or less than 3 days? आप बोलो, अभी आपको समझ में आ गया है. Now you tell me, should I create a liability for 3 days or less than 3 days? Come on, you can speak up. There's no problem.
3 days. 3 days.
Prashant,
Okay. Okay.
why 3 days?
Because we have already utilized 7 days.
He is already availed 7 days. So, see, remember, when you are closing 31st March of the first year, you don't know how many days of leave he will take in the next financial year. Understand? Yahan pe this is theoretical. You know both the facts are given to you, you are able to answer. But think from a practical perspective. You are closing the books at the end of the first year. At the end of first year, this employee has 3 days of unutilized leave. In the future, how much he will utilize? In the future, how much he will utilize? This is something that I don't know sitting at the end of year 1. Everybody, Prashant, Anushi or Priyanka, and I hope Swaminathan also is on the same line. All of you unanimously said 3 days. Why did you say 3 days? Because somebody said he can avail 3 days in the future. Yes? Do you agree? वो 3 दिन ले सकता है. That is the basis behind making a provision for 3 days. Yes or no?
Yes, sir.
But what the standard tells is, standard does not tell you to be overly conservative. See, this is not our problem. This is how we have been trained. यार 3 दिन वो ले सकता है ना आगे जाके. He can avail 3 days of leave in the future ना. So if he can avail 3 days of leave in the future, you make a liability of 3 days. That is our immediate reaction. That is our immediate reaction because we have been trained to be conservative. But what the standard says is you will make a liability of only the number of leaves that the employee is expected to avail in the future. He can avail 3 days is maximum. Okay? उससे ज़्यादा तो वो ले नहीं सकता because he has only 3 days balance available with him. He can avail 3 days is the maximum ceiling of the liability. How much he is expected to avail in the future is a realistic presumption, is a realistic assumption. Are we able to understand the difference between the two? Yes?
Yes, sir.
Can is maximum.
Yes.
Nobody will question. But how much he is expected to avail in the future is an estimate. Is an estimate. Now, when this is an estimate, my only submission is, suppose you estimate, ये 3 दिन utilize नहीं करेगा. He will utilize only 1 day in the future. बहुत मेहनती employee है, वो छुट्टी लेता ही नहीं है. So 10 days तो he's there anyways in the next financial year. Out of these 3 days, he will utilize only 1 day maximum in the future. So the standard gives you the option that, look, you need not create a liability for 3 days. You can create a liability of only 1 day if you estimate he will utilize 1 day in the future. Have you understood? Yes? Have you understood? Bolo.
Yes, sir.
So when you create a liability
Yes, sir.
of only 1 day, your expense that will hit is 30 lakhs, 10,000. Obviously, yes or no? Your expense that will hit is 30 lakhs, 10,000. Do you agree? If I make a liability of only 1 day. And next day, suppose he utilizes 10 plus 1, 11 days. Then this 11 days, 10,000 will get reversed. Are you able to follow?
Yes, sir.
Now comes the last interesting part of this. You make a liability for 1 day, but employee avails 3 days. हो सकता है, is it possible?
Yes, sir. Possible, sir.
Possible. Will you tell the employee, nahi, in my financials, I estimated you will take only 1 day. You have to take only 1 day. How are you taking 3 days? Can you ask the employee that? He will say, boss, whatever you do in your financials is your lookout. Who told you to take 1 day when you had an entitlement of 3 days? Is the employee within the rights to avail additional 3 days of leave? Answer is yes. You have created a liability for how many days? 1 day. But next year, he's taking another 2 days extra. What happens to these 2 days? Is it a prior period error? Tell me, is it an error?
No.
No. Is it a change in estimate?
Yes, sir.
Since it is a change in estimate, the cost will go and hit the next year's profit and loss account. Did you understand?
Yes, sir.
Yes. Priyanka, समझ में आ गया? Anushi, did you follow?
Yes. Yes, sir.
Yes. So
Yes, sir.
I made a liability of 1 day, but next year, he has availed all the 3 days. That additional 2 days, which I did not make a liability for, but he has availed it, will be treated as a cost in the next financial year, and it will hit the next financial year's P&L. It will not be treated as a prior period item or an error in the financial statements. Are we okay with this? Yes.
Yes, sir.
So the interesting part is people can reduce their cost in the current year by making an estimate. And next year they can say that I thought he would not take, but now he has taken. So therefore, you can save some cost here by pushing the estimate out to the next. So that is why when you are doing an audit, it's not just the figures that you are expected to audit. It is these estimates that you are expected to audit. It is these expenses that you are expected to audit. Are we able to follow? Yes.
Yes, sir.
So that takes care of.
So we will charge this in P&L account as employees benefit expense in the next year.
The 2 days additional जो आपने liability नहीं किया था, but he has
हाँ, वही वाला,
availed it
sir.
in the future, it will be charged off to the P&L in the next year. Okay.
Okay, thank you.
Yes, you can have a look at illustration 3. I leave it to you for homework. Okay. Do this for homework. This is what I spoke. Infotech assumes that Niranjan will avail 2 days and therefore they create a liability. But in the next year, he has availed entire 3 days. So you look at this, you will understand. The 10,000 differential which is there, it is hitting the P&L of the second year. Is it okay? Yes. So do this for homework. But yeah, that sorts out your short-term compensated absences. Okay. This one, I leave it to you for homework. This one, I leave it to you for homework. You can go through that. This is important. I leave this to you for homework. The first couple of questions till illustration 5 is more theoretical in nature. Okay. But illustration 6, I'm not saying necessarily from an examination perspective. I'm saying that this is more important from the perspective of practicality. How it happens in practical life, you can refer illustration 6. Okay. Do this for homework. I think you'll be sorted. Okay. So that takes care of this. Okay. Next, short-term employee benefits. I leave this part for homework. Profit sharing and bonus plans. Bonus is there. Profit is to be distributed to the employees. Recognize a liability. The cost will hit the current period and then you will distribute it. So create a liability and pay it off. That's it. So I don't have much to explain on that. I don't have much to explain on this. Okay. Now, one point is there. This will also come in Ind AS 37, which we will be discussing in the next class. See, how many of you understand what a provision is? What is a provision? Provision किसको बोलते हैं? In accounting, you make a provision. What do you understand by provision?
Liability
लायबिलिटी. तो फिर हम उसको लायबिलिटी क्यों नहीं बोलते, हम उसको प्रोविजन क्यों बोलते हैं?
for future.
प्रोविजन फॉर फ्यूचर. तो लायबिलिटी भी फ्यूचर के लिए हो गया ना. I have a current liability. I have showing in my books as a liability, but I pay it in the future. So what is the difference between a provision and a liability?
I
So
think
provision is basically an estimation,
Yes.
whereas in liability we know the exact amount.
Yes. So that's right. She's absolutely right. A provision, both of you are, I mean, Priyanka and even Swaminathan is telling the same thing. But Probably it was just a difference of articulation. So provision is a liability of uncertain amount or timing. या तो आपको अमाउंट पता नहीं है या फिर सेटलमेंट कब होगी वो पता नहीं है. So if either of these two things or both happen, uncertain future, uncertain settlement, or uncertain amount. When these two things are uncertain or either of these two are uncertain, we call it as a provision. We call it as a provision. Okay. Now, there are two types of obligation. There are two types of obligation. One is a legal obligation. One is a constructive obligation. Have you heard these terms before? सुना है आपने कहीं पे? Yes. Have you heard legal and constructive obligation? No response. So I think you have not heard. Okay. A legal obligation is one that arises.
Legal is because of a provided by the statute.
I will not say sticking to a statute. It could be pursuant to a contract also between two people. Okay.
Correct.
There is something in writing. Okay. For example, you are legally bound to pay gratuity to your employee. It becomes your legal obligation. Okay. But there is something known as constructive obligation. Have you heard this term, constructive obligation? Swaminathan, Priyanka, Anushi, Prashant, Resham. Have you heard this term, constructive obligation?
No, sir.
No. Constructive obligation is जब आप okay, nothing is in writing. There is no contract, there is no agreement. But you carry out certain activities which creates an expectation in the minds of the counterparty, and you have no option other than to meet those expectations. You have no option other than meeting those expectations. For example, bonus. We don't look at this question. Okay, don't look at this question. Bonus settlement happens in India usually at festive times. Okay, या तो दिवाली के टाइम पे होगा. Depends. Okay, so typically most of the organizations, they pay out a bonus at the time of Diwali or Dasara or whatever it is. Why do you make the payment at that point of time? Sir, festival hai. People will want the money to spend. So that is why we make the payment at that point of time. Right? What the Bonus Act tells you, आप bonus कब तक दे सकते हो? 8 months from the end of the financial year. So March it ends. So I think by November end you have to pay. You have a habit of making the payment at the time of the festival. It could be Diwali or it could be Ganesh Chaturthi, whatever it is. Okay. Now, are you legally having the option to make the payment till the end of November under the Payment of Bonus Act? आपके पास legally वो right है? Do you have the right to take it forward? Yes. To extend the payment till 30th November. Do you have that right?
Yes, sir.
Yes. Everyone. Unanimously. Yes. Anushi, Priyanka, Prashant.
Yes, sir.
Under the
Yes, sir.
statute, you can push it till November. But can you really push it till November? Or will your employees start demanding, sir, bonus when Diwali or Ganesh festival is round the corner?
Yes.
Yes. So what have you done? You have created an expectation in the minds of the employees. And
Correct.
now You have to meet that expectation. You have to meet that expectation. See, here you have created an expectation about the timing of settlement. Normally you have 8 months, but by making a bonus payout every year at the time of the festival, you have now created an expectation that your bonus will come around Diwali time, which is October, or Ganesh time, which is July, August. So you will sit like that, and then you will say, okay. So I just took festivals as an example. Some companies have the practice of settling in the month of April itself. I March तक काम किया, April में लेके खत्म करो. Okay. So when that is the case, employees will have the expectation, March is over, boss, I need my bonus for the last financial year. You technically have an option to extend it till November, but you have to do it in April because you have created an expectation in the minds of the employees. And if you don't fulfill that obligation, then you will have problems. You will have problems. So you have created a realistic expectation in the minds of the counterparty for which you have no option other than to settle it. So now this is known as a constructive obligation. This is known as a constructive obligation. Is it okay? Yes.
Yes.
So now when we, so this is around the timing. Similarly, there could be a constructive obligation about the settlement amount as well. About the settlement amount as well. Settlement amount kya hai? What is your settlement amount? Settlement amount is nothing but kitna doge? How much will you pay? So increments, if you talk about increments typically they happen a quarter down the line with arrears. Okay, so April tak kaam kiya, then you have the appraisal cycle which runs for 2 to 3 months. And after the appraisal cycle, somewhere in September, October, you will have the increments being rolled out with payment of arrears. So April se September tak you will have one payment that happens as a single shot of arrears. October onwards, you will start getting the enhanced compensation as per the increment that comes to you. Now, the level of increment, kitna milega? Is there anything written in the contract? Answer, probably not. But you may be following certain practices like jitna mera inflation hai. So you have your consumer price inflation index, okay, which shows how much inflation has happened in the last financial year. And past couple of years, you are giving an increment matching that inflation rate. So are you creating an expectation in the minds of the employees?
Yes, sir.
Yes. Do you have a realistic alternative not to fulfill that obligation?
No.
नहीं है, आपको देना पड़ेगा. Are you within your legal rights not to pay that much increment? Answer is yes.
Yes, sir.
Legally, you can avoid the inflation and you can say, I will give only half of that. But can it happen or will it hamper your operations? It ends up hampering your operations. And therefore, this becomes a constructive obligation. So you will still recognize the bonus at the increment and the corresponding liability at the rate of inflation, even though it is not mentioned anywhere. Even though it is not mentioned anywhere. Is it okay? So that is your homework question. Okay. All right. Now we come to post-employment benefits. Okay. Post-employment benefits, these are the benefits which get paid after the employee's employment contract ends. It could end on voluntary resignation. It could end on superannuation. He is told to leave. He is told to resign. उसको हम लोग बोलते हैं termination. We call that as termination, for which there are certain termination benefits that end up getting paid. Okay. Told to resign is a formal, sophisticated way of saying you are sacked from the company. Okay. So told to leave means you end up treating it as a termination benefit. Okay. Post-employment benefits. There are two categories. One is a defined contribution plan The other is a defined benefit plan. One is a defined contribution plan. The other is a defined benefit plan. What do you mean by defined contribution plan? Contribution plan is something like this. Okay, you can read the theory. For now, you can just listen. An entity will pay a certain fixed amount every month. Entity will contribute. Entity will contribute. Think it of like your provident fund. Your provident fund, how much are you liable to contribute? 12% of the salary. Okay. 12% it is, right? So 12% of the salary you contribute. Okay. Do you have an obligation to contribute beyond 12%? Bolo.
No, sir. Answer no.
The answer is no. Absolutely right. You don't have an option to contribute. You don't have a requirement to contribute beyond 12%. So आप डालते जाओगे, you'll go on putting 12%. This money goes to the Provident Fund organization. Okay. The Provident Fund organization gets all these monies, puts it in securities, and then it will give the return to the employees. It will give the return to the employees. This is generally how a Provident Fund works. Are you aware of this much? Yes?
Yes, sir.
Now, suppose when an employee has left and he wants to withdraw his PF balance. When an employee has left and he wants to withdraw his Provident Fund balance, then at that point of time, when he wants to withdraw his PF balance, suppose there was a market crash. ऐसा होगा नहीं, but I'm creating a hypothetical scenario. There was a market crash and the value of his Provident Fund fell down by 80%. It fell down by 80%. My question is, can he go to the company and tell them, look, my PF has fallen down by 80%. As an employer, you have to restore it. Can he tell the employer that in respect of the Provident Fund?
No, sir.
No, because by making a monthly contribution of 12%, the employer has effectively discharged all the liability. The employer has effectively discharged all the liability, and therefore, there is no additional liability on the employer's head. That means the investment risk lies with the employee. Do you understand? Investment risk is what? The risk that the returns will not match the expected returns of the investment. The risk that your investment may be wiped off. The risk that your investment may be wiped off. Anything could happen. So therefore, this is something which the employee is going to bear. The employer says, I have contributed 12%. My story ends there. Are we okay with this? Yes?
Yes, sir.
So no investment risk, no actuarial risk on the employee. Okay. Now, the opposite is a defined benefit plan. What is a defined benefit plan? Defined. You have a definition of what needs to be paid. Gratuity. Gratuity, how is it calculated? $15 days of last drawn salary into
Number of years completed service.
number of years served. Do you agree to this? Yes. ठीक है, 15 days होगा, somebody will say half a month, whatever it is. Okay. Now, is an employer legally required to pay this gratuity as per this formula? Yes. Is this a legal requirement to pay the gratuity? Bolo yaar.
Yes, sir. If the employee is worked more than 5 years, then he is legally entitled to pay it as per the Graduate Act.
He has worked more than 5 years. No doubt about that. So the formula prescribes how much needs to be paid. Can the employer avoid paying this? Answer is no. This amount needs to be paid. This amount needs to be paid. If employer pays less than this, the employee can sue the employer in the labor court and win the case, because this is pertaining to a statutory obligation. So this is an obligation to provide agreed benefits to current and former employees. What happens? Actuarial plus investment risk, both will fall on the entity. So here the liability is with the employer entity. He can retire and I have to pay him gratuity. This is my responsibility. This is my responsibility. I cannot tell the employee this is your responsibility. No. So are you able to follow two distinctions between defined contribution plan and defined benefit plan? In defined benefit plan, the risk falls on the entity. In defined contribution plan, the risk lies with the employee. Okay. So what happens here is the accounting here is pretty complex because there are actuarial assumptions, discounting, so on and so forth that keep happening here. So that is your defined benefit plans. Any doubts so far? Any doubts? No doubts?
No, sir.
Okay, just give me a minute. Okay, yes. So that is your difference between defined contribution and defined benefit plan. Are we okay with this? Yes?
Yes, sir.
Okay. So now, obviously, the more complicated version that is there is defined benefit plans. This is the more complicated aspect. Okay. Whereas your defined contribution plan, straightforward accounting. Okay. All right. So example of cases where entity's obligation is not limited to the amount it agrees. There is a plan benefit formula, gratuity. It was based on the legal requirement. There is a formula. You have to pay the amount as per that formula, no negotiation. Where entity has an obligation through a guarantee of specified return on contributions. So there is a guarantee of a specific return, then it becomes a defined benefit plan. Informal practices. This is a constructive obligation. Constructive obligation. Okay. All right. So I leave this for homework. You can go through this. Okay. You can read up this just for your knowledge sake because I will proceed more towards the accounting. Okay. Homework, 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 homework. Homework. Okay. I'll give this also. Okay. So accounting for defined contribution plans, straightforward, debit employee benefit expense, or if you are constructing an asset, you debit the asset. You debit prepaid expenses if you are paying for the future, credit cash bank, and any accrued liability if it is unpaid. Disclose the amount as an expense for defined contribution plans, and under Ind AS 24, disclose the contribution DCP for defined contribution plan for key managerial personnel. Okay. So obligation is determined by the amount to be contributed for that period. Actuarial assumptions not required. No possibility of actuarial gains or loss. Measured on an undiscounted basis unless you need to settle it beyond a 12-month duration. Okay. So that is your defined contribution plan. I leave this for homework. And now we come to defined benefit plans, which is the most complicated part of the standard and which is something that I want your undivided attention. Okay. We will discuss what are the difficulties in accounting for defined benefit plans, and then we take a break, and then we see the accounting that will happen, and that will kind of close the chapter for today. Okay, this is the last part, termination benefits, and other employment benefits will follow the same template as defined benefit plans. Termination benefits are simpler than this. Okay, so though we will be discussing that, it won't be so much in detail because the crux of your standard is defined benefit plans. Okay, this is the heart of the standard. Okay. See, suppose an employee joins an entity on 1st April 2016 and he is expected to retire on 31st March 2050. That means his service period is 34 years. Tell me, at the end of 34 years, will he be entitled to gratuity? Yes?
Yes, sir.
Obvious.
Yes, sir.
Now,
Yes, sir.
understand, we can interact. But tell me one thing. When he joins on 1st April 2016, should I accrue an amount towards gratuity?
Yes, sir. We need to accrue.
He has not retired. वो retire नहीं हुआ है. He is having his service tenure till 31st March 2050. That is 34 years. Even though I have to pay the gratuity after 34 years, I have to accrue a bit of that gratuity in the first year onwards. Do you agree, Priyanka?
Yes, sir.
Anushi, Ravi?
Yes, sir.
Yes. All right. Now you understand. 2016-17 मैं books close कर रहा हूँ. I am closing the books as at 31st March 2017. This employee has joined, and now I have to look at what? This employee is expected to retire after 34 years. Can I predict whether he will be there for 34 years?
No.
I don't know. So the first problem is attrition. Why? I don't know. Will he be there or not? Next, will the employee live for 34 years? Forget attrition. Will he be alive for 34 years? इसको हम लोग बोलते हैं mortality. We call it as what? Mortality. Will the employee be fit for the job in the next 34 years? उसका accident हो सकता है. He may become impaired in terms of the functions. Yes. If he's working more on things requiring manual, manual labor, and if he has a damage to one of his arms or legs, he could probably be staring at a serious disability for the rest of his job tenure. Okay? Disability. So these three are peculiar to the employee's physical condition. Will he leave the organization? Will he survive mortality or will he become disabled? These are the three broadest assumptions that are required to be made. Next, you are making a payment after 34 years. Liability आप बोल रहे हो, you should accrue it now. If I am accruing something now to be paid after 34 years, do you think we should discount or not discount?
Yeah, we need to discount, sir. We need to
Discount,
arrive
sir.
the present value.
Yes. Prashant,
Yes, sir.
अनुषी, प्रियंका, डिस्काउंटिंग करना है?
Yes, sir.
Yes.
Yes, sir.
Yes, Anushi. Yeah. But which rate? Which rate will you take for discounting? That is an assumption. That is an assumption. आप बोलोगे 34 years के बाद this will be, suppose I have to pay him 1 crore. But today's terms, how much it is? That I will pay after 1 crore, after 34 years. Today's terms, you need the discount rate. You need the discount rate. Okay. Next, do you think what he is paid now, the same he will be paid after 34 years?
No, sir.
हो ही नहीं सकता. What is being paid now, if you pay the same after 2 years, he will leave in the second year only. So you cannot make the payment after 2 years, after 34 years at the same levels. So benefit levels borne by the company plus any future salary increase. This we park it for later discussion. Okay. Various other estimates to be made. So all these things put together are assumptions that need to be made when you are estimating the liability. When you are estimating the liability. Are we able to follow?
Yes, sir.
Yes. So all these assumptions are what we call as actuarial assumptions. These are something known as actuarial assumptions. Okay. So now, what do you mean by actuarial assumptions? They get broadly divided into two categories: demographic and financial assumptions. Demographic and financial assumption. Demographic means pertaining to the characteristics of the employee. Will he leave attrition? What is the mortality? What is the disability status? Yes, all these related to the personal characteristics of the employee will become your actuarial assumption, demographic actuarial assumption. Are we able to follow? Yes.
Yes, sir.
Then there is something known as financial assumptions. What will be the salary increase? What will be the discounting rate? All these things come from the other side. Is it okay? From the financial assumptions. These two assumptions are studied by actuaries. These two assumptions are studied by actuaries, and they will be preparing the final. Working for the defined benefit plan liability. For the defined benefit plan liability. Any doubts so far?
No, sir.
No,
No,
sir.
sir.
Okay. So I leave this for homework. Okay. So not so easy. Too many assumptions, too many variables, too many uncertainties. So we need to navigate these uncertainties and do the accounting. We need to navigate these uncertainties and do the accounting. Is it okay? Yes. So how to navigate those uncertainties, we will have a look after the break. It's almost 8:30, so we meet after 10 minutes. Okay. We meet after 10 minutes. We take a quick break now. And after the break, I think we should be in a position to close this in about half an hour. Okay. So all right. Thanks. Break for 10 minutes, please. All right, so welcome back. So accounting for defined benefit plans. Okay, so what we do is, let us understand with the help of an example, then you can read up the theory. Okay, all right. So we'll look at this particular question, question 9. How does it pan out? Okay, all right. So Acer Limited hired a professional in April 2017 for 6 years of service, terminating in March 2023. Apart from regular salary and an annual bonus, Acer will pay a lump sum remuneration of 45 lakhs. Okay, to her upon termination of employment. So 6 years contract, 6 year contract ends, 45 lakh will be paid. Discount rate is 10% per year. Show how the obligation builds up over the service. Ignore actuarial assumptions other than the presented discount rate. So very simple. So 6 years of service. What is the final payout? The final payout is 45 lakhs. So can I say that for every year of service, some amount gets accrued? Yes or no? Can I say that for every year of service, some amount is getting accrued towards this? Yes. How much is that? Well, 45 lakh divided by 6. So every year, 7,50,000 gets accrued. 7,50,000 gets accrued towards the expenses. We call this as the apportionment of the ultimate benefit to each of the years of service. Ultimate benefit cost is 45 lakhs. I am apportioning it to each of the years. So each of the years means 7,50,000 each. So this is known as projected unit credit method. Each unit, the projection is for 45 lakhs. I am giving it equally over the 6 year period. There is no other basis in which I can in which I can apportion. So 7,50,000, 7,50,000. So one unit of the benefit gets allocated to each year of service. 1 unit is equal to 7,50,000 rupees. The next unit is equal to 7,50,000. Like that, 6 units will be apportioned to each year. So 6 years, 6 units totaling to 45 lakhs. Projected payment is 45 lakhs. Each unit's worth is 7,50,000. So we have done the first step, that is attributing the benefit to the periods of service. Is it okay till now?
Yes, sir.
Okay. Then when is this payable? Sir, this is payable at the end of 6 years. This is payable at the end of 6 years. That means when the service happens in the last year, 31st March 2023, that time there won't be any discounting. So you move on a reverse discounting. At the end of 2022, the discounting period will be 1 year, because from 22 you will be paying in 23, so 1 year. So this is 2 years, 3 years, 4 years, 5 years. Sir, why do you say 5 years? Because you are accruing the cost at the end of the financial year. So on 31st March 18, you would have accrued 7,50,000. 18 to 23 is a 5 year period. So what have you done is 7,50,000 multiplied by 0.6209 to give you 4,65,691. This becomes your opening. To that you will add interest. This is unwinding of discount. You would have studied this in your property plant equipment. Unwinding of discount, we call it as interest. Okay. Next year 0.683. So this will again be 7,50,000 into 0.683. So on and so forth. You go on doing this. At the end, the total comes to 45 lakhs. Are we okay till now? Are we okay till now? Yes? Any doubt so far? Anyone? Please feel free to ask. Boys and girls?
No, sir, no doubt.
Okay, no doubt. What about the girls? Priyanka, Anushi, is it okay?
Yes, sir.
All right, fine.
Yes, sir.
ठीक है प्रियंका?
Yes, sir. Yes, sir.
Okay. उसके बाद the next step is accounting. My employee expense for the first year is 4,65,691. Credit provision for employee benefits. First year's cost is 4,65,000. Next year it is 5,12,260 plus this interest cost of 46,569. Total comes to 5,58,000. This is for year 2. For year 3, this is your employee benefit expense. This ends up becoming your finance cost. This ends up becoming your finance cost. Then 6,19,835 and 1,69,046. Okay. When I say interest, it's typically not interest in our normal understanding. It also goes under the category of employee benefits only. Okay. So this is the one. So like that, we go on doing the accounting and we build up the provision for employee benefits. So if you look at the presentation, what is this 4,65,000, 5,12,000, 563? This is nothing but what we call as current service cost. This is nothing but what we call as current service cost. Okay. Are you able to understand this? Yes. Current service cost is nothing but the value of the service that is being provided in the current period. Is it okay? Yes. Understood this? It is nothing but the benefit multiplied by the discount rate. 7,50,000 multiplied by the discount rate. So this is your current service cost. Any doubts so far? No doubts? Anybody? Okay, fine. I hope you would have understood. So that becomes your current service cost. This is the unit of benefit. What you are seeing here, 7,50,000. Each year's unit of benefit multiplied by discount rate to give you the current service cost. Okay. And then you have the interest cost. And then you have the interest cost. Okay. 10%. So that gives you the closing obligation. That gives you the closing obligation. Any doubt so far, anyone? Yes. Please tell. Anybody has any doubts?
Clear, sir.
All clear? Okay. All right. Fine. So, one second. Okay. Yeah. So that takes care of this question. Okay. And that takes care of this question for you. Okay. All right. Perfect. So I hope you would have understood this. Next. So when we now look at the thing, now you will be able to understand the terms better. Compute the, so if I look at this methodology, step 1, compute the ultimate cost of benefit. In our example, what was the ultimate cost of benefit? What was the ultimate cost of benefit? It was 45 lakhs. It was 45 lakhs. Okay. Discounted to present value of the defined benefit obligation. We did that. Okay. This we will see in the subsequent discussions that will come. Current service cost, we have already seen what it is. Unit multiplied by discounting rate will be the current service cost. Okay. All right. Next. Let us move on. So computing the ultimate cost of benefit, you will consider, I told you, demographic assumption and financial assumptions. Okay. Yes. Now, can these assumptions change year on year? Answer is yes. When those assumptions change, obviously the current service cost and related expenses also will get modified. Okay. So recognize this in. So the impact of change in actuarial assumptions. Because of actuarial assumptions, you will have a change in the other comprehensive income. You will end up having changes in the other comprehensive income. Okay, so that is your demographic assumptions and financial assumptions. Okay, all right, fine. So calculating the actuarial, computing the ultimate cost of benefit to the entity. I leave this for homework. You can go through that. Okay. Now, sometimes what happens is there could be a plan amendment. Instead of 45 lakhs, I decide to pay 50 lakhs. Okay. Instead of 45 lakhs, I pay 50 lakhs. So that becomes a plan amendment. Okay. It is the introduction or withdrawal or changes to a defined benefit plan. What do you mean by curtailment? Reduction in the number of employees covered by the plan. Okay. So when these things happen, you have a plan amendment, or you could be having a curtailment, Then what happens is I am obviously having the current service cost, and I will have something known as a past service cost. Past service cost will be recognized as an expense. When the plan amendment or curtailment happens, or when it recognizes restructuring cost or termination benefits, whichever is earlier, you will book it as an expense in the P&L. Are you able to understand? When there is an amendment, there will be a change in the cost. You will recognize that change in the P&L. Okay? All right, fine. So we look at one more example to see how these plan amendments get accounted. Okay. Very simple question. Okay. Ratna Limited pays a lump sum benefit on termination of service equal to 1% of final salary. So this is the financial assumption. 1% of final salary. The salary in year 1 is 1 lakh, expected to increase at 7% per year. The discount rate is 10%. Show the buildup of the obligation in respect of an employee who is expected to leave at the end of year 5. Ignore all actuarial assumptions other than the given discount rate. Ratna wishes to revise the percentage from 1% to 2.5%. What is this? Is this a plan amendment? Is this an amendment in the plan? Bolo.
Yes, sir. It's amendment in the plan.
It is
Yes,
an
sir.
amendment in the plan. Yes. Because when the employee was onboarded, you gave 1%. Now you are so impressed by his work, you want to make it to 2.5%. This is an amendment in the plan. Discuss the impact if the benefit was revised at the end of year 2, if it was revised at the end of year 5. So accounting as per original assumptions. First one, we do what is original. Forget the amendment. Okay. So salary in year 1, 1 crore. At the end of year 5, 7% increase for 4 years. So that comes to 1.31 crores. Cost of benefit 1.31 crores into 1% into 5 years, 6,55,398. This is the cost that you will be paying. Now we divide that over 5 years. This is your unit. We do the discounting, reverse discounting. So your closing obligation comes up. So this is your journal entry. Do you have any problem till step number 3? Till here, do you have any problem? Priyanka, see, the remaining is mathematical. That I will have to leave it to you. But till now, is it clear? Prashant, Priyanka,
As clear.
Anushi, clear?
Yes, sir.
So till step 3, everybody is clear. Okay, very good. Now we move on to step revised assumptions. Okay. Now you are changing the plan. So cost of benefit is getting revised. Cost of benefit is getting revised at the end of year 2. Let us suppose it gets modified at the end of year 2. Current year 3,27,000, this becomes your cost, which is nothing but 16,38,000 divided by 5. So present value comes to this. This is all as per the new plan. New plan. This is as per the new plan. And now, if we look at 2,95,446, what is this? This is nothing but 4,92,410 minus 1,96,964. New minus old. You are changing the plan in year 2. You are changing the plan in year 2. So therefore, there is an additional cost of 2,95,446, which is hitting you in year 2. Are we okay to understand this? Yes. Did everyone understand this?
Yes, sir.
It's very important. Priyanka, samjha? Anushi, did you follow? Haminathan, did you follow?
Yes, sir.
Yes, sir.
Yeah. Prashant?
Yes, sir.
Okay, fine. So that is 2,95,000. You will take a hit. So now if I look at my entry, year 1 will happen at the old plan. Year 1, how will I even dream कि मेरा plan change होगा? So year 1 will be the same entry, 89,529. Year 2, I will be booking 98,482, 8,953. And I will take past service cost, 402,881 is your provision for employee benefits. So this, everything is old plan. Did you understand? And then, sorry, not this. This is the old plan. Old employee benefit cost, old interest, plus past service cost 2,95,000. So that gives you your provision for employee benefits. Is it okay till here?
Yes, sir.
Yes,
And
sir.
then from year 3 onwards, the new one will come into picture. 2,70,000, 49,241, 3,20,067. This one, and this one. This entire thing is the amended plan. Amended plan. Are we able to follow? Yes. Fairly simple. So past service cost hits the P&L. Okay. This is happening on account of plan amendment. Okay. Next. If the benefit is revised at the end of year 5, then what will happen is same benefit 16,38,000. Only thing is all of this is the old plan. Is the old plan. Did you understand? Yes. And then you will have a catch up 9,83,097. What is this 9,83,097? 1638,495
It's increased.
minus 655,398. Did you understand? Priyanka, samjha?
समझ में आया सर.
Yes. Swaminathan, did you follow?
Yes, sir. Followed, sir.
Followed.
Clear.
Prashant, clear? Anushi, clear? Yes. Okay.
Yes.
That is question 10. That is question 10. This is a change in the plan. This is something which is within the control of the entity. This is something which is within the control of the entity. But now, okay, this is right. Let us then come on to the next one. So this also we have solved. Okay. Gains and losses on settlement, we have recognized it as a cost. Okay. Fine. Discounting also we have done. Which rates, what all needs to be done, you can read this for one purpose. Okay. Okay, I leave this. Okay, now there is a concept known as plan assets. What do you mean by plan assets? Tell me one thing. In this entry that you see, 16 lakhs, the build-up that is being done. In this, do you see anywhere a cash movement? Anywhere is there a cash movement?
No, sir.
No, sir.
No, sir. No, no.
It is just nothing but what you can say, an accrual of cost. Suddenly the cash payment will arise at the end of year 5. At the end of year 5. And when that happens, it will not be a small amount. It will be a big amount. Now the problem is, if it is your accrual of expense with no cash outflow, is there a chance that you may find it difficult to pay this amount because of not having adequate cash at the end of the 5-year term? Yes. Is there a
Yes,
chance
sir.
of some cash crunch?
Yes, sir. Definitely.
Yes. So now the thing is, it's not mandatory, but you can set up assets specifically for this particular payouts. These assets are nothing but instruments, government bonds or fixed deposits. This is something where you would actually end up putting in your, this is something where we would end up putting in the money, setting aside that much money, so that when the employee actually has to retire and leave, we liquidate those assets and we pay back the employee when we pay back the employee. So those assets are known as plan assets. Those assets are known as plan assets. Is it okay?
Okay, sir. It's like look like a forward cover.
It looks like a forward cover. Only thing is, this is not risky. Okay. This will be put in non-risky items. Okay. Yes. You'll put them in FDs, you'll put them in treasury bonds, you'll put them in RBI bonds. Because the intention here is not to make profit. The intention here is to keep the funds available for me for usage whenever needed. Yes or no?
Sir, clear, sir.
Yes. So your intention is not to make any profit out of this. Okay. So you can go through this for homework. Calculation of actual return. You have opening, you have closing, you have employer contribution. So automatically the balancing figure becomes your what you can say actual return on plan assets. Okay. Yes. Now, when you have an asset, when you have plan assets, and then you have an obligation. defined benefit obligation. You have plan assets. These assets are specifically for the employee benefit obligation. Okay, these assets are specifically for the employee benefit obligation. So versus plan assets and employee benefit obligation, the net is either a surplus or a deficiency. The net is either a surplus or a deficiency. Surplus means what? Surplus means your assets are greater than your obligation. Your assets are greater than obligation. Whereas the other side, your deficiency, your obligation is more, you have not funded it. So therefore, it ends up becoming a liability. Therefore, it ends up becoming a liability. Is it okay?
Yes, sir. Clear.
Yes. Priyanka, did you follow?
Yes, sir.
Yes. Okay. Fine. 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 So that takes care of your presentation. You will do a netting off. You will do a netting off. Okay. How do you recognize in the balance sheet? Well, if it is positive, called as deficit, net defined benefit liability, recognized in the balance sheet under provision. If it is negative, surplus, net defined benefit asset, surplus recognized in balance sheet at least of asset ceiling, investments under non-current assets, so on and so forth. Are we okay with this? Yes.
Yes, sir.
So this is just presentation in the balance sheet. Okay, so I leave this to you for homework. I'm just seeing what is important for us to cover. Okay. Now we come on to the main questions, the likelihood of which is there in the exams. Okay. One or two questions and we are sorted. Okay. Bharat Power Limited is a company with a turnover of 27,500 crores. Company has provided a defined benefit plan to its employees. Following information pertains to the balances. So present value of defined benefit obligation 4,200 lakhs opening, 4,740 closing. Fair value of plan assets 3,420 opening, 3,825 closing. For the financial year 1920, the service cost was 1.65 crores. Company made a contribution of 3.33 crores to the plan. No benefits were paid during the year. Consider a discount rate of 8%. Okay, next. Company made a contribution of 1.65 crores, service cost 1.65, contribution of 3.33. No benefits were paid, discount rate of 8%. Compute the balances to be included in the balance sheet, amounts to be recognized in the P&L and other comprehensive income. Give the journal entries in respect of amounts to be recognized. Okay, so that's not a difficult one. So now let us start. See, there are 2-3 ways of doing this. I will prefer a simple account manner so that it becomes easy for us to understand how to do it. Okay. Plan assets. Opening value 3,420. Closing value 3,825. They have said no benefits were paid, so that is why plan assets credit is 0. They have said employer's contribution for the period 3.33 crores to the plan, so 333 lakhs. So this is a balancing figure. It is known as your surplus. It is known as your surplus. Okay. Next, defined benefit obligation. You are given opening 4,200, closing 4,740. Okay. Next, you are given current service cost 165, interest 336. And then actuarial loss ends up becoming a balancing figure. It ends up becoming a balancing figure. Yes? Is it okay? Any doubts so far?
No, sir.
Clear, sir.
Clear. Okay. So that is done. So then what am I going to recognize in the financial statements? Opening net liability, DBO, less opening fair value of plan assets. So that is 780. Net interest expense on net defined benefit obligation. This is something that you are going to recognize as a finance cost. 780 into 8%, 62. Closing net liability 4,740 less assets 3,825, 915. Next, increase in liability. Okay. Remeasurement actual return on plan assets 72 less interest on 3,420, 274 to 202. And net remeasurement less actuarial loss 241. 241. So journal entries are given, extract of balance sheet, you are closing net liability. Are we okay to understand this? Yes, everyone? And
Yes, sir.
Anushi, Priyanka, did you follow?
Yes, sir.
Yes, sir.
Yes. Okay. Swaminathan, Prashant, did you follow? Resham, did you follow?
Yes, sir. Followed, sir. Clear.
Okay. Now, the next one is important in terms of where it gets classified. So this is done. Next one is change in actuarial assumptions. I told you what are my actuarial assumptions: demographic assumptions, financial assumptions. If there is any change in this actuarial assumption, because of which your liability value changes, correspondingly, obviously, the hit will come to the P&L. But the thing is, where should it go in the statement? It should go and sit as other comprehensive income. It should go and sit as other comprehensive income. And will this be reclassified? Answer is no. This will not be reclassified. Why will it not be reclassified? Because this is something which is not in our control as an entity. Change in assumptions. It's not in my control. Tomorrow the markets change. I have to make the changes. It's not something within my control. And therefore we take it inside your, what you can say, we take it inside your other comprehensive income without a reclassification. Okay, without any reclassification. Okay. So based on this, I want you to just go through question number 13 for homework. Same question. Only thing is there is a change in your actuarial assumption. Ratna expects last round salary to be 1.5 crores instead of what we had calculated. What will be the impact of this change? We'll discuss. Is it okay? Yes? Any doubts so far? No doubts? So go through this for homework. I want you to go through this also for homework, your choice. Okay? This one for homework. Homework. Fine. Okay. The last question on this part, I will leave this also for homework. Very nice question. I can read the question out. Arunachalam operates a defined retirement benefits plan for current and former employees. Given the large size, it engaged a firm of actuaries for advice on the contribution levels and overall liabilities of the plan to pay the benefits. Following details are presented. On 1st April 2019, the actuarial valuation of the present value was 15 crores. On the same date, the fair value of the assets of the DBP was rupees 13 crores. On 1st April, the annual market yield on government bonds was 5%. Okay, next. Next. During the year ended 31st March 2020, Arunachalam made contributions of 1.75 crores into the plan, and the plan paid out benefit of 1.05 crores to retired members. Assuming that both these payments were made on 31st March 2020, current service cost for the year ended 31st March 20 was estimated at 1.55 crores. On 28th February 2020, the rules of the plan were amended with retrospective effect, which led to an increase in the present value of the defined benefit obligation by 37.5 lakhs. So this is amendment. This is amendment. Next. During the year, Arunachalam was in negotiation with employee representatives regarding planned redundancies. These negotiations were already completed shortly before the year end, and the redundancy packages were agreed. Impact of these redundancies to reduce the present value of defined benefit obligation by 2 crores. Before 31st May, Arunachalam made payments of 1.875 crores to the employees affected by the compensation for a curtailment of their benefits. These payments were made out of the assets of the retirement benefits plan. On 31st March 2020, the present value of the defined benefit obligation was 17 crores. Fair value of assets was 14 crores. How the above will be accounted for in line with Ind AS 19 and also give extracts of financial statements. Okay. So very interesting question. I think you should be the one who would be trying this out. Okay. I give you about 5 minutes. Okay. Just read the question and see if you can understand. Okay. Then we'll proceed to the next one. Okay. Yeah. Okay, so you could go through. Let us start. Quickly, we run through the where the things need to be placed. It's just a matter of placement, nothing on the solving part. Actuarial valuation of the present value opening was 15, closing is 13. On the fair value of assets was 13. So if we look at the solution, you can go through this. This material would probably be available, or I'll share it with you. So present value of defined benefit obligation opening is 15, assets opening is 13. Next, what are we having? During the year, Arunachalam made contributions of 1.75 crores into the plan, and the plan paid out benefits of 1.05 crore to retired members. Contribution made into the plan. So money paid to the assets. So how much is paid? 1.75 crores. So that adds up to the asset. Next, the plan paid out 1.05 crores. So plan paying out means assets also will reduce and liability also will reduce by 1.05 crores. Are we able to understand? Yes?
Yes, sir.
Okay. Next. Assume that both these payments were made on 31st March 2020. Current service cost estimated at 1.55 crores. So that increases the liability because that is the service provided by employees. So 1.55 crores. Credit, it is increasing the liability. On 28 February, the rules of the plan were amended with retrospective effect, which led to an increase in the present value by 37.5 lakhs. So past service cost, you remember 2,95,446 in the first example that we saw. The same thing has happened here. Plan has been amended. The incremental cost is 37,50,000. So 37,50,000 is your past service cost. And then I think here everything is closed out. Next. On 1st April, the annual market yield on government bonds was 5%. So this is the 65 lakhs. This is nothing but 13 crores into 5%. 13 crores into 5%. Interest cost also 15 crores into 5%. 75 lakhs. Okay. Next. During the year, there were redundancies. The impact of these redundancies was to reduce the present value by 2 crores. So obligation is a gain on settlement. It is reduced by 2 crores. Okay. And for those 2 crores, you made a payment of 1.875 crores. 1.875 crores. Okay. Next. These payments were made out of assets of the retirement benefits plan. On 31st March, the present value of the obligation was 17 crores and fair value of the plan was 14 crores. So closing balance is 14 here, 17 here. So difference is an actuarial gain and here difference is an actuarial loss. Are we able to connect the dots? Swaminathan, Priyanka, Anushi, are you able to connect the dots?
Yes, sir.
Yes?
Yes, sir.
So this separately I have shown defined benefit obligation. Separately we have shown plan assets. Now we are combining it and presenting as one single figure. We are combining it and we will be combining and presenting it as one single figure. Is it okay? Yes. So this is nothing but what is presented here in the accounting ledger format. Okay, this is add less. I have put that in accounting format. Extract of profit or loss, I will have current service cost, I will have interest cost, interest income, past service cost, gain on settlement. That is 1.875 minus 2 crores. Net employee benefit expenses, 19. Okay, sorry, 1.9 crores. Okay, the final net of this, 1.9. Other comprehensive income, 2.375 minus 1.525, giving you 85 lakhs. Cash by, this is just the movement in the cash. That's it. Okay. So very, very comprehensive and exhaustive question. Done. You need to go through it once before we close it up. Okay. So that is the point. Okay. Next. These are all disclosures. You can go through this for homework. I don't have much to discuss. Other long-term employee benefits, anything apart from post-employment. This is a residual one. Like Jubilee or long-term service awards, long-term disability benefits, deferred remuneration, whatever it is. Okay. Accounting will be same like post-employment benefits. That means accounting for deficit or surplus, recognition in P&L or as a liability or an asset in the balance sheet, whatever it is, it will be exactly the same. It will be exactly the same. So I want you to go through this for homework. Question number 16. This is not there in the study mat, an example on this. Okay. So that is your long-term benefits, other long-term benefits. It's totally different, the residual category, but accounting-wise, it is exactly the same as your post-employment benefits. Termination benefits, these are benefits that will be paid when the obligation is termination instead of employee service. Because an employee has left, you are giving this payment, not because he is providing service. Obligating event here is the termination. Obligating event is not the provision of service, is not the provision of service. Okay. So when to recognize employee decision to accept an offer of benefit in exchange of termination, or entity's decision to terminate employment before the normal retirement date. Earlier of, when the benefits can no longer, when entity can no longer withdraw the benefits offered, or the date when the entity recognizes cost for restructuring, which involves payment of termination benefits. Employee's decision or an entity's decision earlier of accepting the offer or restriction to withdraw takes effect. Very commonplace conditions, nothing special. Okay. So that is your termination benefits. Uh, you can go through this question just out of curiosity. Question number 17. You don't have a question on termination benefits in the study module, so you can go through this. Okay. So that is one. These appendices, you can take it for homework. This is purely theoretical. Contribution from employees or third parties. How do we do the accounting, and minimum funding requirements. So when you have these two, three things, how do you deal with that is something that is explained here. It's purely what you can say theoretical. There is no practical questions or anything that is there. You can read it just for the purposes of curiosity, because that forms part of the standard. Okay. So with that, we come to a close on Ind AS 19 as far as the revisionary part is done. So could you understand the overall standard and the overall application? Yeah. Any major doubts that you have? Swaminathan, did you understand?
Yes, sir. Clear, sir. Understood.
Clear? Okay. Priyanka, Samjha?
Hi, sir.
Manushi, did you follow?
Yes, sir.
Yes. Okay. So my suggestion, you please go through this presentation along with these questions, so that you will be more familiar with the topic. There are a lot of additional questions which I obviously did not do because of lack of time, because this is more like a revisionary class, not lack of time. So we have just skimmed through the major questions and the overall applicability of the standard and what is included in that. So once that is done, I think you will be far more comfortable. Okay. In the meanwhile, my suggestion is you can refer to the previous lectures which the institute has already streamed for the prior batches. So there you will have detailed discussions and question solving for these topics, so that you will be better equipped wherever you find some issues on the understanding. I think it will be of a great help to you. Okay. So that's it from my side for today. Okay. There is anything, please let me know.
Sir, thank you so much for the concept clarity, sir. Thank you so much.
Thank you. Thank you, Swaminathan. Thank you. So, okay. Thank you. Thanks. Priyanka, anything else? Nothing else done? Nothing else. Okay. So that's it from my side. We can take it as a session concluded then. We again convene on Friday morning for Ind AS 37, small standard. Lot of examples is what I intend to cover to help you people understand the concept on provisions. Okay, and then that closes
Yes.
the discussion. Okay, then.
Thank you very much, sir.
Thanks. Thank you. Thank you, everyone. Yes, the
Yes, sir.
session concluded.
Thank you, sir.
Yes, thank you. Thanks. The session concluded. Yes, yes. Thank you. Have a nice day. Thanks.